you've been a psych major in college, you've got to try and figure out what the market's thinking and which way the market's going to move if something happens and everything, and it's hard to do that. I mean, people can be right for a while, but you're trying to outguess the psychology of the stock market. Whereas when you're dealing with commodities or currencies specifically, these markets trade on sound fundamentals. So if you understand how these markets trade and understand these fundamentals, you're probably going to be more successful. So I would say if I had to pick a market to trade, I'd stick with the currencies or commodities or something where you can begin to understand the fundamentals of these particular markets. Okay, there are certain cardinal rules of trading that I've found, cardinal truths about trading that I've found through the years, okay? One of them is kind of surprising, is that successful traders that I've observed over the years lose on 70% of their trades. They lose 70% of the time. Anybody follow American baseball? Anybody? No, nobody's ever heard of it. Anyway, in baseball, if you're hitting and you're successful 30% of the time, you wind up in the Baseball Hall of Fame. Okay, so 30% isn't bad. If you're a trader, you can lose, these successful traders lose on 70% of their trades, but they make money on 30%. How do they do that? Well, the way they do that is their losses are a lot of little losses, and what they do is they conserve their capital so that they can come back for the next trade. They don't blow everything on one trade. They don't put their money in a trade and ride it all the way down, hoping and praying, inshallah, that it's going to come back and make money for them. Okay, it doesn't work that way. Okay, what they do is take a lot of little losses, conserve their capital, and look for the successful trades. And obviously, if they're successful traders and they're only successful on 30%, that means the trades they're successful on do a lot better than the ones they lose on. So the point is, just always remember that successful traders lose 70% of the time. The objective is to make sure you keep your capital so you're there for the one trade or the next trade that's going to be a winner for you. Okay? The second cardinal rule of trading, and this is something you should always remember, and this goes along with the first cardinal rule, is cut your losses short and let your profits run. Okay, you don't take quick profits. Okay, you don't. Let's say you buy Swiss francs or euros, and you get a $50 or $100 profit. You say, hey, I'm doing great. I'll take a profit and I'll make another trade. That's not the way to make money in the long run. Basically, what you want to do is use something like technical analysis or some other technique to identify trends in the market and then ride those trends as long as you can. Okay, stay with the trend. As long as the market's moving in your direction, you stay with the trend. How do you know when to get out? You use something called a trailing stop. Is everybody familiar with what a stop order is in trading? Okay, a stop order is you've got a position on. You can't watch it 24 hours a day. The computer may trade 24/7, but you got to sleep once in a while and eat, so you can't watch it every time. So one of the things you might do is put a stop in to limit your loss in case the market all of a sudden moves against you. Okay? What a trailing stop is, when you put a trade in because it's going to trend in a certain way, you will automatically follow up with a stop order in case the market goes against you and stops you out. Don't be afraid to take a loss. Use the stop to let you take you out. Now, let's say that you're right and the trend starts to move in your direction. What you do is simply move that stop up and keep moving the stop up as long as the trend continues. Okay, don't try and pick a top in the trend or the end of the trend. Just keep moving that stop up. After the first one or two times, what's going to happen is you're going to have a profitable trade, and then as long as you ride that and keep moving the stop up, ultimately what's going to happen, the trend's going to stop and turn down, and you're going to get stopped out, but you're still going to have a profit in that particular trade. So use trailing stops. Okay, and as I said, follow the trend. Now, there's two ways to follow the trend. One, we said use technical analysis to identify trends, and we'll talk about that a little bit later, how some basic tools you can use in technical analysis. But the other thing is, if you look at certain markets, you'll notice a big long-term trend. You know, for example, over the last year or so, the euro has been in a downtrend. It doesn't always go continuously down. You get some rallies and everything, and you may get stopped out. But you're better off trading with the downtrend in the euro instead of trying to bet against the euro continuing to. Don't try and pick bottoms in these markets. As long as the trend is moving your direction, you know, trade with the trend. And then the axiom of trading is the trend is your friend, don't buck the trend. You know what buck the trend means? Buck the trend means to go against the trend. So always remember, the trend is your friend, don't buck the trend. That means to go with the trend as long as you can. And then finally, the last cardinal rule of trading I wanted to talk about is money management. Okay? Some people who meet traders who get, or you'll see other firms that may offer, say, okay, you can trade for $500. Okay, you put $500 and you can trade, we'll give you 100 to 1 leverage. You know, you can get a huge position. Bad idea, okay? Because what happens is you commit all your money in that one trade, you don't have anything left in case the first move in the market is against you. So basically, if you talk somebody into trading on 1 to 100 leverage with a minimum account of $500, you're basically doing him a disservice. Because what will happen is he's got maybe a 50-50 chance of that first move in the market after he's bought the currency or sold the currency. He's got a 50-50 chance of that moving in his direction and a 50-50 chance of him going against him. If it goes against him, he's wiped out. There goes the $500. He's got nothing left to make other trades. What you should look for is people with sufficient risk capital where they might commit maybe 25 or 30% of the total capital to a trade and reserve 70 to 75%. So if the first couple ticks after you put the trade on go against you, you can stay with that trade if you're confident in your analysis of the particular market. Okay? So money management means commit a very small percentage of your total account and keep the rest in reserve for the next trade if you're wrong, or to ride out a potentially negative move against you. Okay, now I want to talk about some important concepts regarding trading and investment that you should be aware of before you trade, okay? These things you should understand, and I think some of you understand part of it. I'm not sure all of you understand all of it. But the first one is something we call return on investment. Now that's pretty clear. Most people understand what return on investment is. Basically, let's say we've got two investments, investment A and investment B, where in investment A, the initial payment is $10 million, and the potential return or projected profit on that trade is $1 million, where in investment B, the initial payment is $200,000, the projected profit is $100,000. We can pretty much figure out what our return is. Basically, we calculate the return by dividing that profit by the amount invested and multiplying by 100%. Okay, what we're interested in calculating is what is our percentage return going to be on this particular investment. We don't want to say our return is not, hey, we made $1 million or we made $100,000. What we're looking for is to calculate what is our percentage return. And you'll see people, if you watch CNBC or any of these other news stations, when they talk about investments, they talk about maybe a 10% return on some kind of stock investment, or 5% on treasury bonds or something like that. Basically, what they're doing is calculating the return on investment as the profit divided by the amount invested, multiplying by 100%. Okay, so if we take those two investments we talked about, we see that the first one, we made a profit of $1 million. This is Investment A, we made a profit of $1 million. We invested $10 million. Multiplied, we divide 1 million by 10 million multiplied by 100%. We get a 10% return on investment. Okay, the other investment we see, we made a profit of 100,000 divided by an investment of 200,000 times 100% gives us a 50% return. Okay, so which is the best investment? The one you made $1 million on, or the one you made 100,000 on? What do you think? The answer is not necessarily. Okay, I mean you may have money you're trying to commit. You're trying to increase your capital. You may have $10 million, and here's let's say an investment where you're going to make 10% on $10 million. You know, that's a pretty good investment. The one where you make 100,000 on a $200,000 investment is pretty good, but you still, if you had that 10 million to invest, what do you do with the other 9,800,000? Okay, maybe if you could do that 50 times that 200,000, then it's a much better investment. So it depends. You know, the answer is one isn't necessarily any better than the other. You know, it depends on how much capital you have to commit. But the one thing it does enable you to do is compare apples and oranges. You know, what is the return on investment A? What is the return on investment B? One is 50%, the other is 10%. Okay, the second thing, and this is something I don't think people really take into account when they're trading, and that is, what is the risk associated with this investment? Okay, it's one thing to talk about return. You know, you go out and tell somebody, hey, I got investment B here, you can make a 50% return. And they'll say, hey, great, you know, here's $1 million, you know, do 5 of them for me. You know, but the point is, anytime you make an investment and you're talking about return, you should also in the same breath consider what is the risk on that particular investment. How much capital you're willing to risk. Okay? Let's say we got 2 more investments where investment C has got an expected return of 10% and investment D has an expected return of 3%. Okay? We see how we've calculated that expected return. We see in investment C, there's a 50% chance that that investment will earn 40%. There's also a 50% chance that it's going to lose 20%. So in calculating the expected return on this particular investment, you know, you've got an expected return of 10%, but there's a 50% chance you could lose 20%. Okay, the other investment, the one that earns 3%, shows a 100% return, that, you know, 100% chance that you're going to earn 3% of your money. Now what's better? Which would you rather do? Go with the 100% return of 3% or the 50% chance of making 40% and an expected return of 10%? You're not going to make 10% on that first one. You're either going to make 40% or you're going to lose 20%. It's only through the calculation you get an expected return of 10%. So which is better? The answer is, it depends. The answer to a lot of these questions always is depends. It depends on your tolerance for risk. And that brings us to the third aspect of making an investment that you should consider when you're making this particular investment. And that's what I call risk aversion, or we can also call it risk tolerance. What is your tolerance for risk? Okay? What this particular chart shows, if we take the vertical axis on the left as showing the amount of risk that's associated with a particular trade. Let me just, this being the vertical axis here is risk, and the horizontal axis is return. It shows you that there's the relationship between risk and return for any particular investment is this diagonal line that starts from this point RF and runs through the end of the chart. Okay, what does this mean? Now, basically, if we start at RF, you'll notice that the line RF doesn't start at the corner, it starts a little bit to the right, along the return thing. RF is what we call the risk-free investment. Okay, it might be something like T-bills, where there's virtually zero risk, and you can earn a little bit of money on the thing, okay? M, as we go out to M, we find out that we're increasing our return at the same time we're increasing our risk to get to this M. M is what we call the market portfolio. The market portfolio would be a typical portfolio that we invest in stocks. Okay, you can see, you know, because we're willing to take on more risk, the orange block, we also can get more return out of the thing than our, not the orange block, the lavender block. Because we take on more risk, we expect to get more return. Okay? Now, if somebody said, you know, we had to take on that amount of risk and we only made maybe 1% or so, it might not be worth doing that trade. But you can see the relationship between the market portfolio and the risk-free rate. The market portfolio entails more risk, but it also promises a greater return. And then finally we come out to currencies. Right here. The currencies, you can see trading currencies entails more risk. However, if we want to trade currencies, we trade currencies because we expect greater returns down here on the thing. So the point of this curve is we've calculated what risk is for an investment. We calculate what return is in investment. We have to take in this factor of risk aversion or risk tolerance. How much risk we willing to take. A little old grandmother, you know, is not a, you know, might be a good candidate for a risk-free rate or maybe even the market portfolio, but she's certainly not a good candidate for you know, trading currencies because her heart probably wouldn't be able to take the risk that's associated with trading currencies. Now, there's the other thing, you might see Mr. Vegas, who's, you know, willing to take on all sorts of risk. He's the guy that, you know, wants to take the risk, but he too, he's willing to take more risk, but he too expects a much greater return. Okay, so there's a relationship between risk and return, and what you have to, each trader has to determine what his tolerance for risk is and trade accordingly. Okay, the last principle I'm going to talk about is something called leverage. We talk about leverage, you know, when in trading currencies, 100 to 1 leverage, 50 to 1 leverage. You know, we'll talk about financial calculators, but basically what leverage comes is from the ancient principle that was discovered by Archimedes, the old Greek. Anybody ever heard of Archimedes? Anyway, basically what you've got here is a fulcrum and a lever. And this is supposed to look like a boulder instead of the sun. But what happens is, if you exert pressure at this end of the lever, the further out you go, the less pressure it takes to lift that boulder. So this is the principle of leverage. Now we can convert this to financial leverage. Okay? Let's take, you know, in financial leverage, another term that I like to use is using other people's money to make money. It's always, you know, a pretty good idea. But when we talk about leverage, this is how leverage works in terms of trading. Let's say we've got an investment where our profit is going to be $1 million. Our investment is $10 million times 100%. That gives us a return on investment of 10%. Okay, that's if we commit all our own funds of $10 million, we're going to earn 10%. Now let's say instead of investing $10 million of our own money, we borrow $9 million of somebody else's money and invest only $1 million. Okay? Now let's say we can borrow the $9 million at 5% for 1 year. And this investment's going to take a year to come to fruition. Okay? Now our net investment of our own money is $1 million. We're borrowing the other $9 million on this particular investment. Our net profit now is going to be the $1 million less the $450,000 interest that we paid. Okay, remember we haven't changed the investment at all. We found is some other people that are going to be willing to lend us money. So we see our net profit now is $550,000. When we calculate the return on investment, we have 550,000 divided by 1 million times 100% gives us 55% return on investment. So this is what leverage does for you. Okay, using other people's money to make money, and you know, and this is only using 10 to 1 leverage, not 100 to 1 like you use in currencies. So that sounds pretty good, right? However, there's a downside. Let's take example A again, where we have no leverage. Let's say we invested at $10 million. Okay, instead of making $1 million, we lose $550,000. What's our return on investment? Return on investment is calculated in a negative way, the same way we calculate it in a positive way. In this case, without leverage, our return on investment is minus $550,000 divided by 10 million times 100%, or about minus 5.5%. That's what we've lost on that investment. Now, what happens when we've used leverage and we suffer the same amount of loss? Okay, and now our net loss is our actual loss plus the interest we pay on this particular loan. So what we've got is our loss is $550,000, plus we have to pay the $450,000 back. That's $1 million out of our pockets. Now, how much money of our own did we contribute in this? $1 million. So when you take 1 million minus divided by 1 million plus times 100%, you get 100% loss of your investment. So you're basically wiped out. So leverage is great on the upside as long as it's managed properly and carefully, but there's tremendous risk on the downside. This is why what happens when you're trading currencies on 100 to 1 leverage. You know, it sounds pretty good. You can talk about tremendous profits on the upside, but that money goes out pretty fast on the downside if the market moves against you. Okay? So the use of leverage in this case increased the positive return by a factor of 5.5. However, it caused the negative expected return to increase by 20 times. So that's not a very good trade-off. Okay? Okay, so much for the basic principles of trade. Let's talk about forecasting. Okay? Now, why would you forecast these markets? Why not just, you know, practice all these rules I told you and, you know, just hope for the best? Obviously, you want to forecast because you want to try and predict where these markets are going. Okay? So we forecast to improve the quality of our trading. Okay, now a comment about forecasting and trading and the currency markets. This is probably, you know, if I was in the United States, I'd probably get arrested by the CFTC for this, but I happen to think that the currency markets are the easiest markets to forecast and to trade. You'll probably say, oh yeah, right, you know, tell my customer that. But the point is, I think they're the easiest markets to forecast and also to trade. Okay, the reason I say this is because the currency markets move on macroeconomic factors. Does anybody take basic economics in college? Anybody ever heard of the word economics before? Okay. Anyway, in economics, there are two branches of basic economic theory. There's microeconomics and macroeconomics. Microeconomics is what they call price theory, what affects the price of a particular commodity. Macroeconomics is what the government does to move the markets. So when we talk about macroeconomic factors, we're talking about things that the government has done to affect these particular markets. And these are things that we can track fairly easily and understand how these particular markets operate. And so what I say is that currencies move on macroeconomic factors, not microeconomic factors. So big picture as opposed to little picture. And what this means is when on macroeconomic factors, such as, let's say, interest rate policy or the overall performance of the economy and some of these things, these are factors that once they're in place, they tend to stay in place, which cause these markets to continue to move in the same direction. Remember we said what we're interested in